news galore. This is SME Unleashed. My name is Edwin Obonyo from Strathmore Centre of Value Investing.
And this is Raymond Mutura from Centre for Research on Family Businesses.
Yeah, I've taken a small break. Now I'm back. Today we have a very important guest. Her name is Diana Mureithi.
She can tell us a bit more about
She can say hi at a Saudi.
Yes, my name is Diana Mureithi. I am currently serving as the head of legal and head of private wealth at Andersen, Kenya. We're a global legal and tax firm. Yes, and on social media, I'm known as the private wealth lawyer. Yes, it's a pleasure to be here.
Thank you very much, Diana. We've been running, this is our 10th edition of the show. But as we spoke to you in our inroads and engagements over the years, we've mentioned to you that we have been working with a lot of entrepreneurs. Now, one idea that we've concluded from the point of view of the challenges of family businesses or even entrepreneurs are four things. One is mindset. The second one is
business model.
Business model. We actually introduced it the others in our last discussion with raising capital. But before business model, we used to say mindset, processes, and governance as the challenges. So last week when speaking to raising capital, these are who wealth. They raise capital.
They're in capital raising.
So
they basically, yes.
I think he helped us to understand that also one other problem is business model. It's the lack of clarity in the business model. So that then we used to call it MPC. Now we say M squared PG. No, MPG, M squared PG. Mindset, business model, processes, and governance as challenges of SMEs. I don't know what comments you would have.
Just to add, business model in this case really is how you create value for your customers.
Yeah, how you create value.
How you make money, essentially, so that people can understand what we mean by model here.
Yeah.
I think you need to expound. What do you mean how you create value? Because
it needs to be clear, because in fact, many times when you go to businesses, you find that, okay, so what do? You find that they are a school. But when you go visit them, you realize, oh no, we are a school, we are in agribusiness, we're in real estate. So eventually it starts getting murky. Okay. And therefore you can't say, what do you wake up that gives you money?
Okay. No.
Because if you don't put your attention on that, then most likely you will not make money.
Okay.
Or you will not even be sure, you'll not be very clear on what is making money and what is not making money.
Okay.
And therefore, you're kind of just juakali in the way you operate.
Processes. How does processes? The processes, you mean business processes? And isn't that a part of the business model?
Yeah. First of all, is to know how you make money. But then after that,
creation.
You institutionalize certain processes.
Perhaps maybe I can ask Diana. What do we do with these businesses that have all these things jumbled up from a legal perspective?
Okay, so before we get to the legal, let me make a comment on what you said. So I've also studied strategy at Harvard, if I may. Whoa. And the key determinant of a business, whether a business is profitable or not from a strategy perspective, is actually that. We call it the value stick. It's called customer delight. Is the customer, at the end of the day, is the customer delighted? If the customer is delighted, and we can measure that using the value stick, then we guarantee you will make a profit. This is a profitable business, or this business has, the whatever to make money, to be profitable. So first of all, with regards to your earlier question, I agree that those are four critical things in any business. Governance, obviously, because governance is a legal issue, which I think we'll be getting into more. Processes, because as one of my mentors likes to say, there is no secret to have a successful business. It's all systems and processes. There's no secret. There's a billionaire in every industry. There's a billionaire in the toothpick industry, in the waste management industry, in the legal services. There's a billionaire. It's all systems and processes. Then mindset, because, well, it's either you're seeing clearly or you're seeing through rose-colored glasses or whatever. So mindset is everything. And then finally, business model. Obviously, we've already talked about that. So I agree with all four as critical pillars of any profitable business. And I think if any SME leader decides I'm focusing Q1 on each every quarter on each and clarifying that we've got it done, I think by the end of the year they will have already developed very good laid very good foundations for making a profitable and successful business.
Yeah. Well, maybe one of the other Robert is not here. He's our third co-host. Yeah. But his famous finding is that he says there are very many businesses that are lifestyle businesses. I don't know. What's your comment on that? Because on one hand, we say that, or we are beginning to say that the future of a country like this is through entrepreneurs.
Yes.
When you go into the entrepreneurs themselves, we have those 4 problems that we have. Then you have this other one where somebody has just set up the business for his lifetime. He's not thinking about succession. He's not thinking about somebody else taking it over. He's just saying, look, for now, we will put eggs as long as I'm alive. After that, I don't care what happens. What's your comment on this attitude of a lifestyle business?
First of all, is that it's true. I also have come to the same conclusion, and I've seen Robert's work on LinkedIn, and I've come to the same conclusion because I work in wealth structuring and in estate planning. And I think if you just, it doesn't even need to do much. If you just Google, you will find that the founder dies, the business dies. That's what we are calling a lifestyle business. And in a country that is grappling with unemployment, that is such a shocker that government has not sat down to figure out how are we going to make it easy for businesses to transition to second generation or third generation. And therefore, the second generation or the third generation is not necessarily starting where their parents started. You know, they're starting now on the shoulders of their parents. So it's, for me, I think there's a serious deficit in policy that I think government should actually sit down and think about it. How are we encouraging entrepreneurship? How are we specifically encouraging entrepreneurship within family businesses? Because the other important statistic is that about 60% of our SMEs, or is it even of our GDP, is being generated from family-owned businesses. So you can't ignore that number. You can't just sit and wait for it to restart after every founder dies with every lifetime. So that's quite worrying. I think that from a policy level, someone needs to intervene, but also beyond now the policy level, we as the citizens, the people who are starting these family businesses, need to take responsibility and ask, how do I make sure my children start from my shoulders? By putting in systems that guarantee this business goes to the next generation, and making it easy for the next generation to also pass it to the third generation.
So that's very interesting, and I guess mine also piggybacks on what you just talked about, and this is the question we were talking about, the model, and what Raymond just explained. And that's why I was trying to bring the legal aspect to it. How do we help those people who have everything? So the way he gave you a school, from a legal side, what can we tell them?
So first,
legal and tax, maybe, because also you're a tax, you work in a tax one of the largest tax partnership.
Yes, leading tax firms in the country.
Leading tax firm,
Yes, actually, even globally. So let me say it this way. You're right. Business is a legal creation. You know, like I like to tell people that the father of every business is the Income Tax Act. That's it. Whether or not you have decided you're a sole proprietorship, you're a company, you're an LLP, you're a CB, what are they called? These days there are CBOs, there's also NGOs, or you're a PBO, whatever you have decided, whatever outfit you're using to carry your business, your father is called the Income Tax Act. The father of that business is the Income Tax Act. It has already dictated the tax rate for an LLP. It has already dictated how we decide whether VAT is applicable to the industry you're using. It has decided very many tax laws that you cannot ignore. And then now the mother depends on whichever of those outfits you're using. If your business is a company, the mother is Companies Act. If your business is a sole proprietorship, your mother is the Business Registration Services Act. If your business is an LLP, it's the Limited Liability Partnership Act. If your business is a partnership, a general partnership, it's a Partnerships Act. Just the normal Partnerships Act. So the PBO Act, if you're a PBO, if you're a charitable trust, it's the TPSA. It's called the Trustee Perpetual Succession Act. So all of those laws are the basis, the reason why your business exists. Your business is a legal creation. You cannot ignore that. Now, what happens with family businesses is they're focused on the family part and forget the business part, which is okay. The family part is the legacy part, and it's a very big strength. Because as I've said, 60% of the GDP, that's not a number we can ignore. So the family part is important, but the business part is also critical. Now, if we're a family business that is running 5, 6, 7 lines of business, because what you're describing here are lines of business. I am in the agribusiness. I have a school. I also make the uniforms myself. I also do what else? I also do the transport. We also do the food supply. We also have some contracts there. Especially now that we're in the era of e-teams, that's going to become very visible to the Kenya Revenue Authority. With that visibility, you're going to have to account for the taxes on that income. If that income is not split, you might have a very complicated accounting situation, because now the schooling service, the education services are VAT exempt. But transport, if offered within the same school, is VAT exempt, but if offered from a third party, is not VAT exempt. So you have to have done some math. It can be just you wake up and decide I'm doing it however I want. The uniform situation, what else are you doing? The agribusiness, some of it might be VAT exempt or even it is exempt. The other parts are not. So you have to get to the place where you actually clarify, and it's an accounting question even before it becomes a legal question. Does it make sense for all these service lines to sit in the same under the same entity? Yes. So first, it's an accounting question. The accountant does the math and decides that the tax makes sense if we do it like this, and then the books, the accounting makes sense. From there, now we go to the next level. So it's an accounting question, then a tax question, then now the third level is at a liability question, which is a legal question. Now, does it make sense to have the transport held together with the schooling? Because what happens, I think the case for Loreto Msongari is in the public purview. If that bus has an accident and those children are hurt, the liability is on that school. As opposed to, had we separated these things, the liability would have sat with a separate transport company. But you see, in separating, transport that's not coming from the school is not VAT exempt. So it's a question of, do you want to pay the VAT and minimize the liability? Or do you want to not pay the VAT and carry all the legal liability? And then now, worse, if you're a sole proprietorship, you're carrying that liability in your personal name. So if it's you, Edwin, running the school, you're carrying it in your personal name as yourself, meaning if your house is also in your name and we sue you, there was an accident, that the children have been hurt, so there's a suit in court, a civil suit for you to pay them for, say, loss of limbs, and then general damages are awarded for 100 million. They're being awarded as against you personally, the founder of the school, as opposed to a company that's a third party, which, if it doesn't have the 100 million, will just declare insolvency. Now, you, even though you're declaring insolvency, before you do that, declaring bankruptcy because you're a person, even though you do that, first we're coming for everything you own. Your car, your house, your whatever, anything that is in your name. So there are so many levels. It's not just you wake up and decide, oh, I'm a company. You're not just a company for the sake of being a company. You're a company to mitigate the legal liability. Are you separating businesses or amalgamating them? You do that because of the tax position and the accounting position. So I think founders and business owners start organically, and it's fine to start organically where, okay, fine, it's starting as a side hustle or as an idea we have. But as it grows, you must start seeking out the advice of experts so that you're not sitting in the worst legal position or the worst tax position or worst accounting position.
Yeah. Let's go a bit. I mean, you started by saying families just start. Yeah. And then they don't see the business part, they see the legacy part. Yeah. If even they see the legacy part.
Yeah.
But just try and help and talk to some of those family businesses or even entrepreneurs who may not have this mind, because this is part of mindset. What is it that they miss? Okay. Is it that they rush to entrepreneurship?
Yeah.
That then they miss the idea that, look, fine, it's good to look at family and legacy. But also at the same time, I need to already have seen that this is a business, and therefore all these nice things you've mentioned.
Okay.
I have to answer the accounting question. I have to answer the tax question. Those three things you've said. And I have to answer the liability question.
Okay. So first, in every family business, two things will happen. Either the family will outgrow the business or the business will outgrow the family. Either or. Yeah, we're going to end up there. So when you start, you're not sure. Like I speak, last week I was at an event where someone was, they just bought their business had just managed to buy their own building, and we were celebrating 21 years of that business, and now they have their own building that has their name. And we asked the question, so did you see this coming? They're like, oh my God, like not in my wildest dreams would I have thought we'd get here. And there are a lot of businesses that start like that. It's just a side hustle, then it outgrows any wildest dreams you had. But now what happens, and whereas that is a good thing, what happens is we don't grow with it. The business has grown and has become highly profitable and is funding our lifestyle and is able to make sure we live in the best houses, drive the best cars, do all the things we need to do. Our children are going to the best schools, but we've not gotten to the place where we're like, okay, so what does the business need now? So we need, as the business is growing, I think the most important thing, and it's in mindset, as you said, is you need to keep up with what growth of this business means. Yeah. Growth of this business means also now you're playing in a different field in terms of like liabilities. You're probably needing more capital. Therefore, you're probably getting more loans. You have bigger problems in terms of securitization. You have bigger returns, yes, but you're dealing with bigger numbers with the banks and everything. So I think mindset is critical there. What you want to do is, first of all, seek out that knowledge. I think like the program you run, the family business program, because what happens there is there'll be different, what are they called? Industry leaders. Like me, I come in for legal, someone else will come in for tax. I think someone else comes in for the corporate governance, and different, I see we come in as different industry leaders to just give knowledge on what do you need to do to adopt the best situation? Yeah. So I think first is seeking out the knowledge, not burying your head in the sand and assuming things are just going to work out. I think the insolvency laws in this country changed in 2018. The Companies Act, which is most of the businesses are companies, or even the Business Registration Services Act, both changed, I think, in 2018 and 2016 and 2018. Those two acts changed in that year. So have they kept up with what's new under these acts? Like for the Companies Act, there's so many new things and so many benefits that if you have not updated your articles, you're probably sitting in a worse legal position. So now we've seen the other day the registrar of companies issue a notice and say if by 30th November now passed, you don't update your beneficial ownership, we're going to close your companies. We're going to just deregister them. Yeah. Of course, KRA is like, before you deregister them, let them pay us let them pay us our dues. So please send us that list as you're planning to deregister them. First send the list to KRA. KRA tell you who owes us what, and then deregister them. So what has also happened is now, as founders and business owners have refused to learn and keep up with the trends, the government has said, we'll do it for you. That is why eTeams is here. Because the numbers are clear that we're showing up to vote. We registered to vote 16 million people. 13 million showed up to vote. The payee tax rate, the number of active pins are no more than 5 million. The payee alone is 2.5 million, meaning about 3 million. Meaning in Nairobi alone, which carries about 5 million, it seems like all the taxes being paid by only the people who live in Nairobi. So there's a big informal sector, so to speak, quote unquote, that now we have decided through eTeams, we're tired of this missing trader. We want to see who's this money coming from. So if you're supplying us milk, I'm giving you an eTeams receipt and therefore I've made you visible to KRA. So now what government has done and what policy is doing and what the Revenue Authority is doing is that with all this push we're seeing on, what is it called? The eTeams regulations, also with what we're seeing with now beneficial ownership and all the stuff we're seeing moving forward, even with the insolvency, the Office of the Official Receiver having gone online and made certain things like registration of the securities and everything is all online and very easy now to access, is that it's creating visibility to government. Government knows who's doing this work now. And once we know now, the Revenue Authority will be able to say, now you pay us our dues. So I think one thing I want people to know is, even though you've refused to find out the knowledge, on 1st July 2025, the knowledge will find you. The Revenue Authority will find you.
Just to add on that, I read in Business Dailies that they are attempting to exempt people who are revenue is 5 million from eTeams.
Yes.
I mean, lower than 5 million from eTeams, right? Is that correct? Like the MPs want to not force the people who are making 5 million annual revenue to be on eTeams. The small...
Not for everyone. There are industries that have been suggested, like the small trader farmers and everything. They try to lobby to say, why do we need to keep putting our stuff on eTeams? But not for everyone. Not
go on.
Not for everyone. So what
so let's just go back a bit. Okay. What is eTeams?
So what is eTeams? eTeams is electronic tax invoicing management system.
Okay.
Yeah. So eTeams. Yeah. So the thing is, we noticed that we can see payee is pay as you earn tax. We can see payee, how it's being paid, because everyone who's in formal employment, when they're being paid their money, we're paying their payee. And then we can see VAT, because for the vertable services, once I'm issuing an invoice, it comes with a VAT whatever. We can see income tax, because once I've done all those VAT, and this is where now for formal businesses they are caught, or used to be caught. You pay the VAT, like when we went through tenderpreneurship, when tenderpreneurship became a thing for government. So all of these people incorporate these small businesses, they do the tender. They don't realize that when the government entity withholds 2% of their VAT and sends it to KRA, it has notified KRA, so to speak, there's a small tenderpreneur here. So me as a tenderpreneur, even though I do the 14%, I forgot to do, and then when I'm coming on 30th June, instead of when I'm doing my corporate income tax returns, either I declare nil or I declare some numbers that make no sense. That VAT payment is what then triggers an audit, because the revenue authority can see, oh no, if you supplied goods worth this, because we can count backwards. If you received 2%, it means 16% is this, which means 100% is this, which now when I compare with the returns you filed on 30th June makes no sense. So we trigger an audit and say, we do whatever figure we have here times that 30% of it and tell you at a minimum, we expect this as tax. Then now you come to say, but there were expenses. Now they're like, yeah, prove those expenses. So that is how, first of all, for formal businesses, they were made compliant on the income tax front. It is through VAT. So VAT, it's been a process. Integration has started like 10 years ago. People are only feeling it now. I think in 2013. So it's been a process getting here. But now for informal businesses, after integrating the formal businesses and realizing, fine, as long as we're keeping track of their VAT, we can keep track of their income tax. Now, for informal businesses, there was what we call, and they're paying, there was what we call the missing trader. I don't tell you, you're constantly telling me you have expenses of, say, milk, but I don't know who the person you paid that milk to, where the income tax is. Like, there are no income tax returns for someone who's earning income from selling milk to businesses. So I want to see through to that person. You're also telling me you supply cabbages in this office or whatever. I'm not seeing that person. So those are called missing traders. So eTeams is meant to show those people. Now, me, who has the nice, large, formal business, when you sell me cabbages, I'm insisting that you give me an eTeams invoice. What that does, it puts you on the system. So if you don't file your returns on 30th June, now they will know that you got the following incomes, and because you got those incomes, we're expecting 30% tax from those incomes. If you don't, it'll trigger an audit, which is what I'm saying, that on 1st July 2025, people who will not have filed all those returns or will have assumed that those invoices don't whatever, will see the audit will automatically be triggered because the system will have seen through to them. Yeah. So the rules, to answer your question, some people have proposed, I think like the small traders, the farmers mostly, had proposed the exclusion. I don't have it at mind currently what the current eTeams regulations, who's excluded or who's not, but it's on the regulations, yeah. And they're downloadable from the website, from the internet.
And I guess my question comes back to this is, so I've been providing the milk, but I've been providing the milk as Edwin. So are you saying I need to incorporate the eTeams invoice? They'll give who? Me as Edwin.
So your business, there's a business that provides milk to corporates. So what is that business called? Edwin Enterprises?
Yeah, so I've registered a name on it.
Yes, so that's a business. And now that's now where we discuss governance. Is it wise for you to be running your business as a sole proprietorship, which is a business name, as you're saying? Or do you want to formalize your business and run it as a company and therefore have a separate PIN? If you've registered as a business name, then you have your own personal PIN is the PIN of the business. So there's no separation in liability, which is what I was saying, that if there's an issue, the sins of the business are the sins of the trader, the sins of the trader are the sins of the business. Your assets are commingled. If your house is in your name and a decree is issued against the business, it's issued against the house as well. Like, there's no separation of liability. And then if it's a company, there's a separate PIN. Companies have what we call separate legal personality. By law, we call them juristic persons. There's natural persons, then there's juristic persons. So a company is a juristic person. So they have their own PIN. So the sins of the company are not the sins of the trader, me, the founder or the shareholder, and my sins are not the sins of the company. So there's a separation between those two things, two entities.
Let's go to the mind of this side hustler.
Yeah.
Because already in the program so far, we've said your 21 business, the one you visited last week, they didn't realize that they have reached here and they can own their own building.
Yeah.
And then for a long time also, you've made a lot of insistence that, a side hustler always just has a mind of thinking, look, this is just something I'm doing, of what we've eventually called a lifestyle. So July 1st, 2025 may change this, but there's a bit of a kind of a culture where people are not getting into thinking that they need to really think of this as a business.
Okay.
How do we help the people who are thinking side hustler or lifestyle to have the mind of thinking, I need to think of a business and therefore I need to think about the liabilities that are different. The business has liability versus my own personal liability. There's some education there we need.
Yes.
Yeah, and just to add on to that, what we are seeing also is with Raymond, with the work we've been doing with the SMEs, is that the ones we've seen are mostly an older age group who have kind of not converted to either a company or, a limit, like they have still stayed at sole proprietorship or just business as working with a business name. And so there's not that distinction.
Okay.
And that education will really help them transition to their companies. But we are struggling to see how we can
help them
to move, because he's saying, I've done this for 20 years
and I'm making money.
Yeah.
What is the problem?
What's the issue?
First, I think it's remembering ignorance of the law is not a defense. For a long time, the law did not catch up. But now, because of regulations such as beneficial ownership, regulations such as the e-teams regulations, the law will catch up now. Now the law has caught up. Now the law has gotten to the place where we're like, okay, fine. We know there are missing traders. We know that there's business being conducted in what is called the informal sector. So, I think for a long time, people have buried their heads in the sand and there was room for that. But as I'm saying, once the first year of e-teams runs, and then when now, in the past, there was no way for KRA knowing you actually delivered that milk or you delivered those cabbages. But now, because we, the large corporate, have insisted on you issuing us an e-teams receipt, or otherwise you won't have our business, because we don't want to get to the end of the year and we don't have allowable expenses, because they've said the only expenses that will be allowed are the ones that are e-teams compliant. So me, if I want to make sure that I claim the services you're giving me, whether you're selling me pens, whether you're selling me computers, whether you're selling whatever it is you're selling, whether you're cleaning our office every week. So the only way for me to make sure those services are allowable expenses of my books is to make sure they're e-teams compliant. So I'm insisting on whoever is supplying those services giving me an e-teams receipt. So you have now given me an e-teams receipt, which was not a requirement before, which is why there was a missing trader. KRA didn't have visibility to who you were. They did not know who you were. Now, but with you issuing that receipt now they know who you are. They know your PIN number, they know your name, and they expect that you're going to file 30% of your of whatever revenue you earn, less allowable expenses. You're going to file some tax on it. You're going to submit tax on it. But now what happens if you, the small trader, now are not taking e-teams receipts from other people? But now you've taken ours. So in total, you've received, you've sold us milk worth 1 million shillings. So KRA can say at a minimum, you received 1 million. Now, maybe for instance, your employees, they're not tax compliant. So you're not paying them through the system. You're just giving them cash. So you're going, to KRA, you have no expenses. They will expect 30% of that.
30% of whatever
of
turnover.
That, or whatever revenue they're seeing of the turnover. But now, if you want to claim expenses, you're also going to have to make sure that people get in the system, whether it's the guy you employ on the ground. So now he's paying payee and whatever. That's the goal of e-teams, that all of us get on the system. The more it gets formalized, the tax base expands. So now we're not getting a lot of tax from a smaller tax base. We're getting maybe average. I don't know if the rates, eventually they keep saying the rates may come down, especially the corporate income tax rates may come down once the tax 25. Base is expanded to 25. But we're going to wait and see if government does that. But in the meantime, that's the goal, to expand the tax base. So I think for a long time it may have been an opportunity for it to be a side hustle. But if you're put now in the system, if you're supplying anyone who's already in the system, they're not going to accept non-e-teams compliance receipts. So now even you're going to get on the system. But also if you're in a risky business, for instance, a business where something, an accident can happen, or you can be sued because of something that happens in the course of the business, you also will need to prove compliance, because such will be now another trigger for where is this money coming from? The other thing we've seen the KRA doing is, for everyone who files nil returns, and then you've purported to buy a house, they go back, you bought a house. You know what? Once you're buying a house or you're buying any asset, maybe property, there's stamp duty payable. Once the stamp duty is paid, the system triggers for capital gains tax to be paid, and in that moment, we are seeing all the PIN numbers for everyone. So they compare that with your income tax return and realize for the last 5 years, you filed nil returns. So they're like, how is it you're able to buy property worth 10 million? The other day I saw someone who bought an expensive car. You're able to buy a car worth this much and all your tax returns say zero. So where is this money coming from? So we are giving you an opportunity to go and amend your tax returns for the last 5 years because there's money. And the Tax Procedures Act gives the commissioner power to even go to the bank and ask for your bank statements and find out the correct position. So what people are now, the pressure people are now starting to feel now is pressure that has been mounting from the last 10 years since we started. I think before teams, it used to be called TMs or something.
Teams.
Yeah, it used to be called, this to be a name we used to call the integration of the tax revenue system. I can't remember the name. So it started like 10 years ago. It's just that now we've gotten to the place where we can authoritatively say there was income here. And if there was income, there's tax due here.
So the education is on what now? So what are we teaching this older generation that
the laws have changed?
Okay.
Well, the law is caught up, and that you can't just talk about a side hustle with a business name, and that you need to. I mean, she's put it very well. You have an accounting question, you have a tax question, and you have a liability question. So those three questions are very important for a business moving forward. Otherwise, you have a tax issue, you have to eventually align to the law. If you have an accounting issue, then maybe you're not making good money because of not having appropriate accounting practices. Or if you have a liability issue, you're just fixing yourself as an individual. Yeah, so...
And it's also to remember, as I've said, the law has changed. So now please get to know the new law because ignorance of the law is not a defense. You will not come and say, I didn't know.
Yeah. Well, it sounds scary. All this sounds very scary.
And also because big companies have this department called internal audit, which helps with compliance, right?
Yeah.
So what are the new rules? Are we compliant? But SMEs don't have that leeway. So I'm just wondering, how can they
stay compliant?
Yes. How do they get to know these new changes?
Well, I guess it's a challenge to us, but I think what is a bit scary is, of course, that you can't just talk about being in a side hustle without, adhering to the law.
So there are no side hustles anymore then.
Yeah, I mean, and that is the mentality we need. Well, you can still say a company. You can still say you have a side hustle company.
So that's side hustle company.
Side hustle company. It can't just be ni kujaribu to those terms that people say ni jua kali tu.
So what we're saying is, the moment people are contracting on their quote unquote side hustles, the first question they ask each other is, do you want an ATM receipt? If you want an ATM receipt, there is no side hustle here. I'm in the system. I'm going to have to pay taxes on that. So if usually in my side hustle, I'd have charged you 10,000. Now I'll charge you 10,000 plus the 16% for VAT because I have to account for it. And then if my revenue is above currently 5 million, or if it's, and then what is it called? And I'm going to have to account for the 30% tax that I'll have to charge on it. So whatever my side hustle quote would have been cannot continue to be that, which is exactly the same way tenderpreneurship was professionalized. Everyone first initially thought, okay, all of us can be tenderpreneurs, we just do whatever. But now once the 2% is remitted to KRA and now 14% is being expected by KRA, and then now if you're the tenderpreneur, you have gotten a tender, you have supplied, you have agreed kickbacks to everyone. Karibu 50% is kickbacks. You've been left with 50%. The cost of getting the good was like 25%. So it really just been left with 25% of the money. Then KRA knocks and says, oh yeah, we received 2% from the procuring entity. So where's the rest of the 14%? So you give. And then again knocks at the end of the month and said, oh yeah, so there was revenue, and we can't see any expenses because the kickbacks are not allowable expenses.
Yeah, where is it?
So where's the 30% of the total? Yeah. And then you realize there's no money I've made. Yeah, it's not. That's how entrepreneurship ceased to died very quickly. There's a time it was a big deal.
And you're saying also in the future it will die.
Yeah.
From 1st July 2025.
So now side hustles, that's how they're gonna die. Why?
Entrepreneurship, according to her, already died.
Yeah.
Because now we are on side hustle.
Yeah. So now you'll see that now people doing tenders are formal businesses which have quoted for the right. You remember there was a season where tenders were just being run by like people. I am a lawyer, but I am here with a construction tender, whatever. There was a time, there's a period things were really, really bad. Now I think it's been, we're seeing at least more people who've been in the business longer, people who actually understand the business of what's happening, because now they know they'll have to account for all those things. And when you're quoting a price, you have to quote knowing you account for the VAT cost, you have to quote knowing you account for the fact that you will pay income tax at the end of the year. Now, for side hustles, what we are seeing and what we are seeing is, now, the first question is, do you want an eTIMS receipt? If you want an eTIMS receipt because you also have a business where you need to claim expenses, because you also, if I'm receiving milk for my employees, I want to claim that as an expense of this business from the revenue I get from legal services, right? So if I don't get an eTIMS receipt, I won't be allowed to claim it, meaning I will have to account to behave as though I didn't pay for that milk, which I don't want. That means I'm paying tax on that money. I don't want that. So I will insist on an eTIMS receipt. So now the question people are doing is asking, do you want an eTIMS receipt? So if an eTIMS receipt is there, then it's no longer a side hustle. Now it's a proper business. KRA has visibility to it. You will need to account for VAT if you're within the VAT bracket. You'll need to account for corporate income tax at the end of the year. Based on the revenue you've received. Now, for people who don't want eTIMS receipt, if you're, for instance, selling dresses, so the people buying from you the dresses are for personal consumption, like they're personal dresses, we cannot count them as allowable expenses in my business, then you might not, your side hustle can remain because no one is insisting on eTIMS compliant receipts. But if you're selling to Citizen TV, which needs to account for the dresses that its newscasters wear, then you can't remain. So
you're just saying it will affect mostly the ones that are doing business to business, not necessarily business to customer, because business to customer, they might not ask for.
Well, some customers maybe have a wardrobe allowance.
No, but we are so used to not asking for receipts as customers.
Yeah.
So are we going to be, I don't think it will change that drastically. Recently, KRA ran a campaign in which they were trying to entice people to be asking for receipts from the businesses. I don't know if you...
Yeah, we've seen it. It's all over Twitter. Yeah.
And the idea was to try and whoever is doing this might get some money as part of the rewards.
Yes.
Because I guess the KRA was trying to teach us to be asking for receipts.
Yes.
But are we there yet? Not so, right? Would I be saying right?
So I've seen the arguments on Twitter as well. So it's that you get ask for the campaign was saying ask for a receipt, then scan the receipt so KRA knows whether or not that receipt is compliant and everything.
For example, the butchery in your estate, when you buy your 2 kilos, you don't ask for receipt.
So I might not necessarily care to ask for the receipt, but let me tell you a story I had about 3 weeks ago about someone who walked into a place, they were not given a receipt, they uploaded it and they reported. So these people happened to be the paramilitary, or they happened to be someone affiliated to KRA, and they reported it. So triggers an audit on this business. So now if I don't like your business, that's basis for me to just, report you, whistleblow on you. So people will be asking themselves, do I want to take that risk or do I want to be compliant? That's exactly the mindset KRA is pushing for.
And then there's one thing which, of all these taxes we've talked about, corporates and all that, there's one thing I know maybe perhaps you can explain to people out there, which is the turnover tax, which is different from corporate tax, right?
Yes, you make a choice.
So you make a choice of either to go the 30% route or the turnover route.
Who makes the choice?
You, the business, as long as you have, let me just say I'm not a tax expert, but I work at a tax firm. But let me say how turnover tax works. So I think the current threshold is 25 million. If your total revenue is below 25 million, you have the option of either paying corporate income tax. That's at 30% minus allowable. You allow all expenses 30%, or you go the turnover tax route. So you make the choice. It's also the same for residential rental income. You make the choice. Do I want to pay tax at the rate of 30%, but then I deduct all my expenses, or do I want to pay at a rate of 7.5% on the gross without deducting? It's an accounting question. You just do the math and you see where it makes sense for you. If I'm a person who has built these residential units with a lot of bank loans, and therefore my interest from the bank is quite high, because like now interest rates are high, the interest is an allowable expense. So even though I'm receiving $1 million and then I realize I can deduct 900,000 because of the interest, so 30% of 100K is still less than 7.5% of the full $1 million without whatever. So it's a question that your accountant just makes a decision on where are we paying, where are we less exposed, which tax position is better for us. It's a math question.
So then just to finalize on this legal question, what we are telling entrepreneurs, especially those who have always thought with a lifestyle mentality or side hustle mentality, it's good to be formal. It's good to think through these things. And I guess the motivation is the cost of not doing it.
Yeah, the cost of non-compliance.
Of the cost of non-compliance. And I guess the thing is, many, and you probably always hear Kenyans say that, well, then this is going to burden my business. Things are going to get more complicated. I'm going to lose more money. Do you want to talk to that? Is there something we can tell them?
What people sometimes forget is that it's a full ecosystem. You remember when I was telling you, so after you have not accounted for the tax on this money, then it's sitting in your bank account. Then you buy property worth 10 million. How are you going to explain where this 10 million came from? When we look at your income tax returns, which I'm telling you now, in this year alone, we've seen those emails from KRA. You must have seen them being tweeted on Twitter, where KRA writes and says, "Hi, we have seen you purchase property worth X millions. We have looked at your tax returns and your pay, they're nil or they are below or whatever. So could you just explain to us the disparity?" I personally don't think, as a lawyer, I don't agree with KRA's move on that. But I also know that they're the revenue authority. So that's their mandate. They need to get to the place where they can collect. So what I'm saying is it needs to be thought out fully. You need to think about it very clearly. I do agree that when it starts out, it's a side hustle. It has not yet grown. But if this business has now grown, liabilities are growing. Do you want to be sued in your name? Like it's a multifaceted question, which you have. The business gets to a certain level, and for us, the level is 5 million. Once the revenue gets to 5 million, first the VAT question comes up. If your business revenue annually is above 5 million currently, they're trying to increase it to 8 million. If it's 5 million currently and it has not, and you become now liable for VAT, so you're supposed to go register and actually make sure you get VAT and actually make sure you become VAT compliant. Yeah. Then beyond that now, once you're VAT compliant, now you need to start accounting for the taxes and everything, which is why also now you as a business will want to keep all the expenses you're having, the receipts for them to be ETINS compliant so that you have more to deduct. The question for compliance, there's people want to wiggle around it, but really there's no way. It's just comply.
and compliance. So we've talked a lot about tax compliance, but there's much more to compliance.
Yes, there is.
So what other facets are there apart from tax?
Yeah. Oh, good. That's a good question. And actually, that reminds me, we didn't answer your other question about big firms, which is a perfect question in terms of big firms have internal audit. Who tells them every day how to comply? But what about for SMEs? And for SMEs, I think one advantage we have in this market when it comes to professional advisors is, I think there are tier 1 firms which are maybe more expensive or service the bigger, larger corporates. But then there's tier 2, but then there's also smaller SMEs that are also professional service firms. So the point is, and now knowledge is everywhere. It's you have access, even though you're not a client of my firm, you have access to our material because we're writing about it. Is on our website every day. All the tier 1 firms are writing about all the things on the business amendment bill. All of us are written about it. So it's first that the knowledge is there, and so seek out the knowledge. That's number one. Don't bury your head in the sand. Attend the programs we're saying. Even like the FB program, the Trailblazing program is not necessarily very expensive. So first seek out that knowledge. That's number one, because you don't have necessarily the same big team for compliance. But then now number 2 is start to understand what compliance looks like at this level, because at a minimum first you have the county. If you're being issued the trading license, the county has required certain things of you so that you can get that trading license. There is OSHA, Occupational Safety and Health Act, and now for OSHA, even for larger corporates, we have to advise on whether the business is compliant. Do you have a fire escape? Do you have a fire extinguisher? Do you have all those things? If it's a complicated business, do you have helmets or whatever they need to do? There are standards for which you need to comply with. So again, I would suggest is finding a way to get the information and the advisors at the level your business is at. You don't have to go and get the tier 1 firms if your business is still as an SME. There are SME advisors at that level. Or I think now these days we even have virtual offerings for I can be the legal officer virtually for someone. I don't have to be present, seated there, because it's a system. We've already operationalized those systems in our offices, so we know how to do it. So I think it's the question for compliance, as I had said, is first of all find out what the legal obligations the law has created on you. There's the tax obligations. There's legal, as I've said. Now, legal for compliance is, as I've said, is corporate structures. That's beneficial ownership. Are you a company? Have you filed the returns? If you're an LLP, you're required to file something called something of solvency every year. So have you done all of that? Then there's the Occupational Health and Safety Act. Have you done that? Then there's the employment law. With regards to the employment law, there's requirements. Are the employing contracts written? Are they in accordance with the law, with the Employment Act in terms of, are you giving the right leave days? Do you have a manual that speaks to certain things, or will you wait until you're sued by an employee to realize that? Recently, we advised on a matter where the exposure was that when you give an employee a salary, you need to state whether the housing allowance is incorporated. It's a simple issue. For lawyers, we just need to state your salary as consolidated. Once I say it's a consolidated salary, it means I have included the housing allowance. If I have not, there's now case law from the court that says that if you did not state it as consolidated, you just stated it as basic, at all times you owed me 15% of everything I was earning as my housing allowance. So at the time when we're terminating is when the guy says, oh, but they've not been giving me housing allowance. So 15% for every year I've worked for all the 7 years I've been here. So you see, that's a big exposure on the company. Why? Because they assume that they can draw an employment contract by themselves, not realizing that just one word has such massive legal implication, tax implication. Because again, when you pay that housing allowance on that, there's pay due on it that you are not paying. So you also have to account it to the KRA as well, yeah. And whatever. So you can't continue to ignore that the law, as I said, the law created your business. Yeah. Your business is a legal creation. It's a baby of the law. So you have to comply with the law.
But you don't, as a mother, the father is who?
The Income Tax Act. And the mother can change,
based because on the way you've registered yourself. So either a company,
yes.
Company
if you're a company, it's a Companies Act. If you're a business name, it's a Business Registration Services Act. If you're an LLP, it's the LLP Act. If you're a partnership, it's a Partnerships Act. If you're a PBO, it's a PBO Act. If you're a charitable trust, it's a TPSA. If you're a family trust, it's a TPSA. Yeah. So it depends.
Wow. I hope you remember all those words. And by the way, when you listen, we'll have also the recording on YouTube, so you can listen over 3 or 4 times to ensure you know where you sit properly.
You just need to remember yours. If yours is a business name, remember yours.
Okay, there you go. And the final session today, we are going to look at governance, and we're dividing it into 2 ways. So we'll talk about governance in terms of boards, and then the final part will be delving deep also on family business governance. So we start with non-family before we go to family. So you are trying to explain to us what kind of board, what the 2 types of boards, and then how do we start setting up boards?
Okay, yeah. So if your business is registered as a company, this would be private limited liability company, whether if you're not for profit, you're a company limited by guarantee, or you're a charitable trust or a PBO, whatever it is you're doing, then there's a governing body. There's someone, because this is a juristic person. This is, I already explained, to the juristic person. There's a human element. Who's the mind of this company? We call that the board of directors. So we can have one-man boards, pursuant to our current Companies Act that came into force in 2015. We can have a one-man board, which means I am the board, I myself alone. Where before the 2015, we couldn't have one-man boards. We did at least 2 people on a board, but now we can have one-man boards. So now the question is, the truth of the matter is, as long as the company is incorporated, the registrar of companies has received a report on who the mind of the company is, who the board is. So either it's you, the founder, and you're one person, or it's you and your spouse, or whoever. If the founders are 2, you're 2 people. So that's the board of directors. Now the question is, do you understand your mandate as a board of directors? So a board of directors essentially should be focused on oversight and foresight in terms of the future of the company and strategy. Like they're at a higher level. But now we have something known as executive boards and non-executive boards, where the people on the board of directors perform functions within the business. Those are called executive boards. Where they don't perform functions in the day-to-day running of the business, those are non-executive boards. Now, where the nature of the board can change, can be multifaceted. So we can either have a board that is executive or non-executive, or we can have a mix. We can have, there are 2 executive directors, because me, I'm the principal, and my husband also is the CFO. So we both work in the business. We are the executive board members, but we have maybe our children or someone else who doesn't work in the business on the CR12 also as a board member. So now that's an executive director. But at the same time, now, if you want third parties, if you want, say, lawyers, your business is a point where there's a lot of navigation on legal aspects, or there's navigation on financial aspects. So you want a lawyer, or you want a finance expert, or you want a strategy expert on the board. Now the question is, do you put these people on the CR12 and make them an actual member of the board, or do you have them sit in the board in an advisory capacity, meaning they're sitting as part of an advisory board, but they don't have the right to vote on the matters? So the best practice governance-wise for all boards, whether public boards, private boards, or whatever, is to make decisions by consensus. Consensus means we discuss and then we agree, oh yeah, that makes sense. We receive the advice of experts, which now could be these strategy experts, legal experts, finance experts, who are, so to speak, members of the board, but only in an advisory capacity because they don't have a voting right. And then we make the decision and say, yeah, let's go that route. That's the best way to make decisions. But sometimes in boards, push can come to shove and we have to vote on it, which now in that case, if we're voting, the only people who vote are the people who are appearing on the CR12, because now that's the actual board of directors. So when SMEs are bringing in, when SMEs are constituting their boards, they need to have to discuss what exactly is the need. We have told you the mandate of the board is oversight and foresight. So what do we need for oversight and foresight? Number one, the CEO of the business will be reporting directly to the board. So they will be sitting on the board. Do you want to have him have a dual role as a CEO, which is an employment role, and then as a board member, which is a consultancy role? So we'll have 2 different contracts here, so that we can fire you as a board member, we can remove you as a board member, but you can retain your CEO. Or many times the CEO contract will also say that if you are holding a dual seat as a board member, you're being fired as CEO also automatically means you're removed. For family businesses, sometimes those things change. So we'll get to that later. Secondly, what do we need? What needs do we have? We want a legal expert. We want a strategy expert. Are we ready for that strategy expert to have a vote on these matters? And then once they appear on the CR12, removing them is a longer process. Removal of a director is a process that would require either the members to pass a resolution pursuant to the Companies Act, or sometimes to go to court because they will refuse to be removed, because the Companies Act also provides a requirement that if you're trying to remove me as a director, I can lodge a protest and then I can move to court to say why I don't want to be removed. So do we want to put them as actual directors and give them those actual voting rights and everything? So if we're not yet ready to do that, they come in as advisory boards. So we will have them on all the paperwork for the company that they are part of the board, and they will be sitting on all the board meetings, but they are only an advisory board. They're able to give their input. Then finally, decisions for a good board, decisions will be made by consensus, meaning their input will have been discussed and the decision made. But for when there's problems, they will not be involved in the actual vote if the matter is put to the vote. So yeah, when constituting boards, that you want to just consider the need your business has and the type of people you need, because sometimes for some boards you will need certain type of personalities. Sometimes, like especially for regulated entities, if you're in the IRA, if you're regulated by the Insurance Regulatory Authority or the CBK or any other regulator like the RBA, you will be told if you're a corporate trustee company, we must see someone with finance experience over this year. We must see gender balance. We must see there will be
registered with this body.
Yeah.
Okay.
Yes.
So thank you for that. So then we have these meetings we'll be holding. What goes into these meetings?
But before the meetings, there is what is common with SMEs? What are we seeing? Is it advisory boards? Is it
so? Organic growth again goes back to that. It was a side hustle. We registered the company. So when we were registering, it's me and my brother or me and whoever else are starting this company. So when we are growing, we're just growing like that. We make decisions at our board level decisions, but we literally make them in the car, in the house, at the dining table. That's what we are seeing. Like it's a board, so to speak, and all the documents are signed by me and the co-founder, my husband, my brother, my sister, whoever it is. But really, we're not running it as a board. We are almost running it as a subsistent thing. Like over the dinner table, I call and say, I'm thinking we get into this contract. Yes, no, we sign things. I'm thinking we get this loan. Yes, no, we get. So it's still being run very subsistently. So we see that because at the point of registration, someone has to be on the board. People are just put there as what we call seat fillers. Yeah, but once the business grows, and I can mention quite many businesses that are in court today because the seat fillers disputed. They reach somewhere, the business outgrew them, and then now you realize, oh, I carry so much power as a board member. I can do the XYZ. Then the other guy saying, what are you doing? This is my business. I will only put you there because I needed another person there. And I've been, no, but I'm here now. So you can't, yes, I'm a director. You can't remove me. So you have, but when the business is young, and because of organic growth, the business is growing organically, mostly it just starts at that very low level. We're just doing it because the law requires us to say who's a director. But as the business is growing, and as I've been saying, you must also start adapting as the business is adapting. You must start saying, now we've reached the point where we need a board charter. So do we have the right the right people as the board members? Have we chosen the right balance in terms of what I bring to the table in terms of qualifications and what I am good at? Or are we, because also what you'll see with family businesses, sometimes you'll come and you'll find all the children are directors. Some of them have no idea what the business does. Some of them live abroad. But now it means when the fight starts, it will be impossible to move because the articles of association say quorum for a board is 4 people. Now 4 people cannot meet at the same time, meaning when push comes to shove, it's only when you'll realize it's a problem. But when things are working well, you will not know that this is a problem.
Yeah. So you are explaining now the minutes.
The minutes.
Yeah, after
so at
to Raymond.
So a board meeting ideally should be discussing, as I've said, if this is so boards work through, so the board ideally should sit once a quarter or 2 or 3 times a year. Boards are not, they're not the exec committee. They're not the ones running. They're not senior management. You need to separate the concept of senior management and the board. So if there are things that require to be done more often, it can be done through board committees. So the board, for instance, can have a committee on finance and accounts. So that's a committee that has just the board member responsible for finance who sits with the CFO, who sits with maybe the other person in credit control or whatever, to create policies, to make decisions that need to be made when there are many bank things that happen, to make those things. So those ones can be sitting as a committee. So ideally, that's how it should run. Sometimes the businesses are small, so the committee may just be made up of the same people as the board members, but it's a place to start with the SMEs. What we would advise is constitute the board, first of all, based on the needs of the SME and where the SME is. So for instance, it's a medium enterprise based on what it needs. Bloated boards are not advised. Having an unnecessarily big number is not, it's just going to make it harder to make decisions. As much as possible, choose people whom there can be consensus in decision making. We're aligned in the way we think so that we don't have to argue and vote on everything. A board that constantly has to vote on issues already in itself is a red flag because it means we're not agreeing on so many things. Yeah, we're not aligned in our thinking. Mindsets are wrong. Yeah. So you want to also constitute one that has the right qualifications and the right alignments with regards to where the business is going, and it should be dynamic. If the business is in a big phase for strategy now, then let us see people who have add value in terms of strategy. If the business is in a big phase for navigating regulatory stuff, then let's see the lawyers or the whatever. If the business is in a big part for, finance and financing and raising capital and whatever, the finance experts are useful. So make those decisions based on what you need. So you don't need everyone at the same time. So have that provision. So ideally, as I was saying, the board meetings would be either quarterly, mostly it's either quarterly, once every quarter. And then board committee meetings can be more often if there's a certain thing happening. For instance, now a new law has just come up and there's a lot of compliance. The legal committee can be constituted. And then after we are done with that, the legal committee is disbanded. It doesn't need to remain. So it's on a needs basis. Yeah. Of course, some committees are what we call standing committees. Even in like our businesses, we have to have them as standing committees because there is that is always continually ongoing. Yeah. And then what they discuss at board level, you want to receive reports. You want to receive reports from the CEO to understand whether the business is following. So the board should have drafted the strategy. The strategy can be a 1-year strategy. It's short-term and long-term strategy. So we need to know 0 to 5 what the business is looking at. In this year, this is what we're doing. So the board is receiving reports from whoever runs the business, the CEO, to see we're in keeping with the strategy. The board may also be receiving a report from the CFO in terms of the numbers that aligns to whether we're meeting the numbers and the other markers we put as the other revenue markers we put as KPIs for the business. And then also if there's anything from legal, you can be receiving. So you'll have every business, every board will have come up with its own strategy, business strategy, and created markers for what they want to check to know whether they're getting to where they're going. So the things that relate to those KPIs will be submitted on as board papers. So ideally, when we're coming in for the board meeting, we'll receive what is known as a board pack. So a board pack is just a report of all those things. And the board pack will have been checked either by the CEO or if there is for large corporations, there's usually a secretary.
Yeah.
The secretary. So the law currently does not require businesses to all of them have secretaries. If your share capital is below 5 million, you don't have to have a secretary. And many of them, these ones, their share capital is below 5 million. 5 million.
Oh, so share capital below 5 million.
Yeah, and that's not turnover. Share capital is not turnover. I'm not saying that if your business makes more than 5 million, you have to have a secretary. No, share capital is the number that's appearing on your CR12. So you'll find that almost all these businesses have been incorporated with a share capital of about 100,000.
It's less than 5
yeah.
million.
Usually we start
okay.
at 100,000, even 40,000. Yeah, it's your decision to if you want to increase to those numbers. So you'll find that now for SMEs, they might not necessarily. It's not a mandatory for them to have the secretaries. They can designate any of the board members to take that to take up that role. But if they do have a secretary or they have a legal officer within the business, the person in legal or compliance can take up that role. Yeah, because it's a question of just drafting the minutes and everything. So the board will receive those reports. The board ideally should sit for like 2 to 3 hours to review the reports. Now, since the reports for most boards is that we receive the report at least 48 hours in advance. Some is even 7 days in advance. So you've looked at it and you formed opinions. Then the resolutions have been proposed. So boards make their decisions through resolutions. So the resolutions have already been proposed in the papers received. So we are proposing to adapt this report. We're proposing to sign a contract for this. We're proposing to get more loans from XYZ, to raise capital from this. Now, based on the paperwork provided, it will be easy for us to just make those pass those resolutions. Once we've passed the resolutions, we've given power to the senior management to go do those things. So again, we'll come back in the next quarter to check how far has senior management gone with this. So that's the whole essence of a board, and that's how it becomes now. That's how it helps in professionalizing the business, because now this founder is technically reporting to someone. Someone is keeping him accountable. He's no longer just a side hustle.
Yeah.
Wow.
Yeah.
Wow. Thank you.
You probably have had experience of, you could say, some founders and co-founders finding it difficult to go through all this that you're talking about.
Yeah.
What advice would you give? Because we started by saying, look, it's important to be aware that we need to, you could say, formalize the business. We need to move from lifestyle business, side hustle business to formalization. And we went into in the first part of the discussion, we talked about have all those accounting questions sorted out, tax questions sorted out, and liability questions sorted out. Now we are beginning to say, look, this is a business. And therefore, for you to run a business, then you have to go into a bit of this. Yeah. This going into a bit of this, which is a bit more, it's heavy for founders who think, I'm very original in my thoughts. And probably have experience of, how do you have to change the founder to think this way, to begin inviting external people, other people, or even begin looking at their fellow directors as directors and not as my children or some friend I put you into this, or I need to change the people I put into the CR12. How do you help founders to realign to this thought process?
I think the easiest way, and of course it's founder syndrome is a thing. Yeah, founders, they know I'm the one who started this business, I know how to run this business. Yes. Letting go of these roles is hard. So founder syndrome is a real ailment. But I think the easiest way to cure founder syndrome is to calculate the opportunity cost. The opportunity cost of not having proper succession planning for the CEO founder role is, it's a lifestyle business. It dies with you. That's the opportunity cost. Are you ready to pay that cost? You're not paying it today, but every day you don't make that plans, you're getting closer to paying it eventually. And then the opportunity cost of not having the right people advising you on the right issues is now, as we were saying, you end up finding yourself in non-compliance, and you carry the liability of that non-compliance. So is not necessarily always a glaring cost. That's the thing about opportunity cost in anything. There is an opportunity cost for us being here right now and not being wherever else we could be. So at those costs we have minded ourselves to and said, okay, fine, I want to carry it. So I think it's founders sitting with that business and realizing this business has now outgrown me. They don't like to come to that realization. They do not get to the place. And we said it. One of two things will happen. The business will outgrow you, or the business will outgrow the family, or the family will outgrow the business, in which case you are not successful now. It's a subsistence farming, it's local farming here. It's it's for eating, and then what is subsistence farming? Exactly. It's subsistence. That's what it is. So I think sitting down and understanding what the opportunity cost is, will make you make a decision as to whether you want to formalize, professionalize, comply. You want to do all those things. And if you decide that you don't want to, appropriate that risk and be ready for it. Be ready for when you die, your business will die. Be ready.
Before we go to family business governance, that quick question is, who drafts the letter to appoint the board members?
Okay. So the board, first of all, is appointed. The initial board is appointed at incorporation.
Okay.
When you're incorporating, someone is on the board.
Yes. Okay.
That's the initial board. From there, as you wish to appoint more, the process of appointing new board members is on the existing board members. The Articles of Association have already defined what is quorum. Quorum is the number of board members we need to make a decision. So if there are 2 and 1 dies, then it means the remaining one needs to appoint someone else so that we can get to quorum level. And also defines the maximum number. So sometimes you'll see it has a maximum of 6 board members. So we can add, we can keep the number between 2 to 6 if that's what it has said.
You're saying this is in the MEMAs?
It's in the articles, yes, the Articles of Association. So MEMAs means Memorandum and Articles of Association, but we've since changed. The memorandum is now a 1-pager called a CR2. So now it's in the Articles of Association. So the Articles of Association have given this mandate to the board as currently constituted to do those things. Okay. So it's passed by resolution again. All decisions of a company are done by resolution. So the board will pass a resolution, but the articles these days provide for resolutions by counterpart. That means I can sign one and you sign one as a board member, and together they're read together as one. Or even for virtual meetings, sometimes we can also waive the need for an actual physical meeting and pass these decisions. So the articles have spoken to all these things.
Let's go now to family business governance.
Well, so far, what you've been talking about is what we've been calling family business governance.
Yes.
But of course, when you talk about a family business, the family is involved. And, we've interacted about this concept and said, look, we also have to think about the family governance. On the other hand, otherwise then you have a problem. Well, do you want to talk to that and tell us what's the difference?
Okay. So as I said, business is a business regardless. So the unique thing about a family business is the family part. So that now when it comes to governance of say us, a consultancy firm like ours, is governance on what we've already spoken about, business governance. But when it comes to family business governance, is twofold. It's family governance, then business governance. Depending on the stage of this family business, if this is a business that's at the founder stage or at the sibling partnership stage or at the dynasty cousin confederation stage, the family governance tools are different because there's different involvement of the family members. At the sibling partnership stage is basically the stage at which there's more than one level of the family involved. So there's the founder level and there's a next level. Then at the cousin confederation level, there's 3 levels, or now the family more than that are involved. So now say for instance at the founder level, because it's only founder level, you don't have something like a family employment policy because it's just the founder and maybe his wife. It's just him, he's in control. But at a sibling partnership level, we're starting to see nieces and nephews and uncles and whoever else coming into the picture. Then we want to discuss, how does someone get employed in this family as a family, in this business as a family member? So a family employment policy is one of the tools we would use, and that family employment policy would need to have been embedded also either in one of the governing documents in the company. It can be embedded to the articles, it can be part of the board charter. It needs to sit somewhere as a proper document within the legal structure of that company. If we're at the cousin confederation level and now we're dealing with a big family that has 3-4 generations involved or 4 levels of the family involved, then at that moment we might even want to go as far as a family constitution to discuss. Because now, I think the Ford family, so their last meeting had 1,600 family members. We can't have 1,600 people making a decision. So how do we make sure that we have a consensus decision that's coming from the 1,600 people? So the 1,600 people usually meet in something known as a family assembly. They discuss key things or a total key issues the family is considered about. And then through the family council, they make a decision that is then communicated to the actual board. You will find that some members of that family council are sitting in the actual board or have a way that they relay the information to the person who's representing the family in the board. And this person is bound to take the position that has been given by the family council. So to speak, a family assembly is just a get-together. It's a fancy term for a get-together. And then a family council is just a fancy term for the committee that is chosen by the get-together to be the one that represents the family.
The family business.
So those are all the tools.
But I know whenever you teach in our family business course, one of the comments you make is that it is very important
Yes.
to remember
Yes.
that the family business constitution is not legally binding. You're very famous in saying this, but then you always suggest a few ideas on what
Yeah.
to do. So what would you say on this?
So we have had matters in court, mostly in the UK courts, where the family constitution has come up for discussion, and many times the family constitution is drawn up as an ideal document, as a family charter, which is also a whole other thing. The values, we agree as a family, we are honest, we're transparent, we're whatever, but courts have no way of enforcing honesty and transparency. It's a court of law. We enforce the law. So if, for instance, you are going to draw up a family constitution, you want to make sure, first of all, it speaks to issues that the court can actually, because, it will only become useful when push comes to shove. When you guys are agreeing, it's fine. But when you're not agreeing is when we're going to call up on it. So you want to make sure it speaks to issues that the court can definitively speak about. And I want to always say the dispute resolution clause is very important, and many other clauses. But now if you're also going to insist on putting those nice values and all of those things there, whatever you do also, you want to make sure that that family constitution has been given prominence within the legal structure.
Yeah.
Because it's a court of law, it's concerned with the law and the legal structure. So if the legal structure is the articles of association, and the articles of association and the shareholders agreement make no mention of this family constitution, then it doesn't have a basis when we are trying to resolve a dispute.
Yeah.
So you want to make sure that if you're going to create a family constitution, then you also make provision for it within this legal structure. The easiest way is to actually entrench it or make reference to it from the articles of association or the shareholders agreement, as the case may be.
Yeah.
So the lawyers help draft the family constitution and then also put it in the articles of association.
Yes, we have to amend all those documents. So this structure is one. It's a legal structure. It's that if you've decided you're constituting a family constitution and you're going to manage the family and the family's input is important in the business, then you want to create room in the articles, because the articles are the constitutive document for the company. You want to create room in the one document that the court will look to when it's trying to decide, what do I do? Was this done according to procedure? So the procedure you're saying is that there must have been a decision of the family council. So you have to have provided in the articles that nexus between the family constitution, so that that decision is then relayed to the actual board, then the board, so that now you're going to court to say the board did not implement, or the representative of the board did not do what the family council said. So if you don't create this nexus, the law will be like, it was wishful thinking.
So let me just give an example. So we have two brothers, each are married. They had a family constitution. So when one dies, the wife now says, I want the shares of the founder, but he's dead, so I take it over. So are you saying that now the constitution should say what? The constitution should say that upon the demise of one of the brothers, either the shares go to the kids or the wife has no say, because we know of cases where the wife goes to court and say, now I need my 20% because the man died. And
okay, that's an excellent question. It actually presents the dilemma that plays out in court very well. So when the man dies, the man is a shareholder. Yeah. So what dictates how shares in this company are devolved? The family constitution or the articles? The articles. And if there is a shareholders agreement, the shareholders agreement. In your case, I think there is no shareholders agreement. So they would have dictated. Now, within the articles, there could have been a clause called a permitted transfer clause that says, if the shares are devolving to my wife, the board does not need approval. If there is no such clause, then it still has to come for board approval. And board approval is this remaining brother. Yes? So that's number one. Number two, there's another law here, the Law of Succession Act. Did this man die intestate, or did he die with a will? Did his will say the shares are going to his children or to his wife or to his brother or to which third party? So once the Law of Succession Act deals, if he died intestate and then it devolves to his wife or to his children, whoever it devolves with, when that person comes to the company is regulated by the Companies Act. So the Companies Act tells you, let me see your articles. Do your articles have a permitted transfer clause? Do they say that it goes directly to this person without approval of the board? If it's a daughter, a spouse, or a son? If there's no such clause, then subject it to a board meeting where the approval for the shares to transmit happens, which means that at this board meeting level, we can say we refuse to admit you as a member. We're going to give you the value of those shares in cash, because that's the essence of a private company, that we reserve as the board the right to deny access to anyone. So this surviving brother, depending on whatever he wants, he can say, no, I'm going to pay you the value of these shares, you the person with the grant from the succession court. I'm not going to admit you as a member. If the shareholders agreement did not speak to that, if the articles did not speak to that, now you see the family constitution doesn't matter. because it's not part of the legal structure at this level. So if you had made that decision in the family constitution, then you want to make sure that it comes and be put somewhere in the appropriate legal, in the governing documents within the legal structure. So for the family constitution, if first of all, in that case, is that you ensure the documents, the most important document in a company is the articles. So draw the articles with the, we call it customize them. Customize them with the issues you want, all the matters I've mentioned, whether you want a permitted transfer clause or not, whether you want a shareholders agreement or not, what is the status of that shareholders agreement, you can do that. Now, if you decide to go further and create a third document, then the reason why I don't necessarily advocate for family constitutions and whatever, the more the documents, the more likely there will be ambiguity. And the more likely that these documents will conflict.
Raymond is now laughing inside because you're the one who keeps preaching family business constitution and you're hearing the lawyer say,
no, I'm not saying they're bad. No, I'm not saying they're bad. I'm saying align it to the whatever.
But the first caveat is the more the documents. Listen to what she has said.
The more the documents.
That's true of any business.
This is still part of family governance.
Yeah.
Fine.
Yes.
But
so you need to be aware.
Of association.
Exactly. Yes. But in articles of association,
that's business governance.
You can eventually bring the idea very clearly. That
because
the family business constitution should be looked at.
Yes. Because if it's a large family, we
Diana,
can put all that information in the articles.
Sasa now you're trying to sway Raymond's side. Umetuambia we deal with the articles of association na shareholders agreement. It was very clear.
No.
You might have a trust and
there's
then
a family business governance and there's a family governance. Those two governances must be dealt with.
Yes, and
we
must
can deal with other things
merged.
with Daktari next
Yes.
time. This business of being Daktari is what confusing problems.
Thank you so much for us having you, or is it for how do we put it?
It's for us hosting you.
Oh, us having her.
Us hosting you, Diana.
Okay.
Yeah, for making, we've been arranging this show for how many weeks now, Diana? When you're busy now, particularly ndio
Doing private lawyer,
yeni VIP issues. Apatikani vizuri. Ama haraka. Thank you for coming for this episode. You really shared a lot of knowledge that we've learned, both me and Raymond as well. And we also hope the listeners will gain something, one or two things from these insights. Looking forward to the next episode. Any final remarks, Diana, before we go?
I think what I like to tell people is when you know better, you do better. Now you know about your teams, please comply, or at least talk to your accountants or your tax experts and do what needs to be done. Don't wait for things to get bad. Now you know about beneficial ownership, you know about all the other regulations that apply. So if you know better, you do better. Yes. Yeah. So let's hope they do better.
Thank you so much. This is SME Unleashed. My name is Edwin Obonyo from Strathmore Centre Value Investing.
And Raymond Mutura from Croft, since you are complaining about my
name. You are giving us too many names here. And our guest as she leaves,
Diana Mureithi, Head of Legal at Andersen, also known as the Private Cost Lawyer.
See you soon.